Hello, let's make a brief technical and fundamental analysis on OFI. Fresh new look on it. Okay, let's check the charts. This is the all history chart. The IPO was in 2002, late 2002, at about $3, and then the stock came down to less than half a dollar. It went up here on this bull trend to 4.4 and then declined, but we had this huge gap up here, breakaway gap above the 4.4. I took advantage of this move. I don't know if all of it, but some of it, and sold recently because this is a very low margin business, but we'll get to fundamentals later. Okay, the medium term chart, here you have that breakaway gap, and the stock continued that way. It was really hard to, I bought it here and again here. It looked very high, and now I'm sure if the stock were to trade at 4.5 or so, it would look very low. But back then it was difficult to buy it here, even though it was right, of course. Okay, this is not the medium term, this is the short term chart. Well, the stock is approaching this 5.45 support level, and the 200 days moving average is coming up here at about 4.35. So the short term trend is bearish, but the long term trend is still bullish. It looks like we're under some consolidation here. Earnings were out here, and the market didn't like those. They were below expectations. Let's make a brief fundamental analysis. Okay, this is the share count since 2000. It was 9.4 million there, but the IPO only happened here in the beginning of 2003, I believe. So the share count jumped to 4.8 million then, and it remained more or less stable since then. 15.3 million shares now, and 85 million market cap. So this is a very small market cap company. Share count has been growing at 0.8% average annual pace since 2003, and the market cap has been growing a lot, 80% since 2003 too, on average per year. So this is a huge bull run. It was 8 million in 2003, 85 million now. Okay, let's move on. This is a balance sheet study. We have here long-term debt and the current ratio. These red bars are the long-term debt, which is high, 33 million in 2001 and 37 million now in 2006. When the company reported this fiscal second quarter earnings, it didn't show a balance sheet or an income statement, which it's not very pleasant. So I have just this 2006 number of 37 million long-term debt, and the current ratio is low at 1.14 now, but the best it has ever been. But the balance sheet is weak. Look here, our cash and marketable securities account for just 6.67% of total current assets, and receivables account for 47% and inventory 33%. So this is a weak balance sheet, but stable. Okay, move on. As for revenues and gross margin, these are revenues. They were 113 million in 1999 and 168 million in 2006. The expected 407. The analyst was expecting 212.5 million, but now just 194.5 million. It reduced its estimates by almost 20 million due to the weak fiscal second quarter results. Gross margin is low and stable here around just 14%. Revenues are growing 77% since 99 on a CAGR basis, and the industry average grew 8.7% from 2005 to 2006. As for gross margin, the industry has a much higher gross margin, about double, of 28.9%, and this is why the industry is valued at 1.1 times sales and OFI just 0.4 times sales, because it is a very low margin business, unfortunately. We don't know if the company will meet these estimates. They talked about 200 million revenue rate starting in fiscal 2008, I believe. So perhaps it will meet these estimates. As for earnings per share and net profit margin, well, earnings per share have been unstable historically. The company lost here 53 cents in 2003, but now it had 24 cents of profit in 05 and 32 cents in 2006. Expected for 07, 47 cents, but the company made just 6 cents in fiscal second quarter. And let me see here for the first quarter, just a second. Where is this? Okay, it made 16 cents so far in half a year, so it will be hard to meet this estimate of 47 cents. Very hard indeed. Anyway, we have an earnings per share compound annual growth rate since 1999 of 24.8%, net profit margin of 3%, and the price to earnings ratio using 2006 numbers is 17.4 for OFI and 23.7 for the industry average. On my valuation model, these yellow lines are known facts, the white lines are the estimates I need to make, and these dark yellow lines are calculated automatically by the model. So as a dilution factor, I put just 2% because the historical dilution rate is just 0.8%, but the balance sheet is quite weak, so let's put 2% here. Revenue compound annual growth rate going forward, 10%. It has been 7% historically, but the company had these new very big customers, so 10% I think it will be achievable. Final net profit margin, 4%. It has been 3%, but with revenue growth, perhaps the company in 2009, this is 3 years from now, will achieve 4%. And an earnings per share multiple estimate equal to the industry average of 23.7 gives me using this data, the model says the stock will be trading at $13.08 in 2009, so it will rise 32.9% a year on average, and the optimal selling price given this is 8.38 today. This would be the price where the stock would start returning less than 16%. So I consider it attractive. It surprises me that such a low margin business can be attractive. That's because the stock is cheap on a multiple comparison. So I'm surprised, and perhaps I'll buy it on a further dip. I'll keep a look on it. I already made 2 or 3 successful trades on this stock, but for a long-term investment, I prefer high margin businesses and not this low growth, low margin business. That's more risky. If something fails, the company will lose money. But on a 1 to 10 scale, I give it an 8. Thank you. Bye.